So I think it's a pretty clever trick of the Sloan School to reserve seating up front for the Dean's Circle, thereby solving the age-old problem of how do you get people to actually sit in the front rows. Not to mention it provides a nice incentive for the givers. Thank you all for your generosity to the Sloan School. Okay, my name is Archon Basu. I'm a Sloan MBA class of '99. Thank you. Okay, good. And it's my pleasure to introduce Antoinette. I think this is going to be a real treat. I've not heard Antoinette speak, but my wife has, and I think many of you probably have. And she's a real star here at the Sloan School who was not here in '99. And we were just talking about the fact that the class she teaches, entrepreneurial finance, did not exist in 1999. So this is a course. I'm sure many of you have taken it or are familiar with it. But it's a course about how venture capital and private equity work, about the economics of the deal structures. There's a lot to know for people that haven't looked at that part of the industry, and it's something that Antoinette has done tremendous work on. She is, as you know, the Michael M. Kerner Professor of Entrepreneurship and Professor of Finance here at the Sloan School. She's been here since 2003. When she finished her PhD at the University of Chicago, and she's originally from Germany, at the bachelor's at the University of Cologne. Just by way of very quick introduction, for another 30 seconds, I want to mention two really cool things that Antoinette has done. That it's a real pleasure when they pulled my name out of a hat to introduce her, because she's actually one of the authors that I've long been a fan of. In addition to her seminal work on private equity, performance, and flows, which she did with Steve Kaplan and others, she also more recently has been looking into the behavior of individual investors at a financial firm. That's not named in her paper, but I'm sure they're very happy with the work you've done. And in that work, she has quantified a really important topic for our world today. I know you won't necessarily be talking about this, but perhaps you can take questions. She's talked about how the political polarization of the United States today has entered into the way that market expectations are set, which is a really interesting question, right? We know that there are lots of problems with the political separation. There was a wonderful talk earlier today by Professor Simon Johnson talking about the need and the opportunity to re-energize investment and R&D in America. This is one of many problems we have. But it's really interesting to transition from the classic rational expectations idea in economics that we all have been fed on to truly understanding how political views can in fact seep into your economic judgments. So anyway, I'm a huge fan of Antoinette. Thank you so much for coming. And you're here to tell us about FinTech for a changing world. So welcome.
Thank you very much. Thank you, Arjun, for an extremely generous and kind introduction. Now I can only let you down. But it's a really great pleasure to be here with you, and it's awesome to see so many former students. In fact, you were even generous to me. I've been here till actually 2001. I dare not to say. Yes, but what I want to talk about today is indeed FinTech for a changing world. And what I thought I'll do is, rather than talk to you about what I'm sure you've heard a lot about, which is things like how FinTech can change the transaction costs of reaching customers and how it might change market structure, I think that is all right. That's also, very well understood. In fact, I would say that is not the biggest change that FinTech is bringing. The biggest change, in my opinion, is that no matter whether we think of FinTech as affecting a lot of startups who are now coming into the industry, or what you see more and more now, being the industry consolidating and actually acquiring a lot of, the established players, acquiring a lot of FinTech innovation. What this actually has led to, and will lead more and more to, is that underwriting standards, issuing standards, and the targeting of customers will change dramatically. And so what I want to talk about is how the fact that we can model people and people's behavior with big data, with machine learning in a much better way, how this interacts with consumers' behavioral biases. So what has already happened, in fact, that has happened over the last 20 years, is to use medium big data, right? Or a colleague of mine likes to say laptop big data. So that type of data has been used to improve the modeling of credit risk. But what we are seeing more and more now is firms becoming sophisticated, not just about understanding people's willingness to default or economic stresses that make them default, but indeed understanding how people use financial services and how they themselves sometimes can be their own best enemies. And of course, in a competitive financial environment, for-profit firms have to respond to this, right? And so what I want to show you is how these behavioral biases affect the targeting of customers and then what this means for market dynamics. All right, so given that we only have 45 minutes, I can't teach you the details of behavioral finance, so I just wanted to show you behavioral finance in two fun photos. So this one, right, is, as you can see, these gentlemen are going to the gym, but, they had the chance to walk, but they don't, right? So it's just the typical thing where you see, inattention is something that's prevalent everywhere, but as I will show you also, it's incredibly prevalent in how people interact with their consumer finances, right? I'm sure you're all extremely well-trained in finance. You're all at the very height of the sophistication scale in the US population, but probably many of you even have sometimes forgotten to pay their credit card, right? Not for lack of understanding, but, we're all very busy. So inattention can be one way of how behavioral finance or behavioral economics affect us. The other very fun one that lots of you have probably seen is that self-control and if you want procrastination and these type of behavioral issues can, again, affect people's rational decision or undermine rational decision. So many of you might have seen the famous marshmallow experiment. If you haven't, you should go on YouTube and watch it. It's really cute. And what it does is, so what happened here, this is already actually the first time it was done more than 20 years ago. You bring a bunch of children into the lab and you tell them that, there's a marshmallow sitting here. If you can hold off for 5 minutes not to eat it, when the experimenter comes back into the room, you will get 2 marshmallows. And the interesting thing then is, the experimenter goes out, but it's not told to the poor little children that they're being taped, right? And what you see is some children literally stare down the marshmallow, but don't touch it. Some people turn even the chair around not to stare at the marshmallow, which is quite smarty, right? She's awesome because she touches it, but she controls herself. And then this little guy, no way, right? So why am I showing you this? Actually, I'm showing you this not to make fun of small children, which is not cool, but because actually the interesting thing of this study is that the first time the study was done, the psychologists actually followed the children for 25 years thereafter and saw that the children that managed to have self-control had much better lifetime outcomes in terms of school achievement, workplace achievement, than the children that couldn't control themselves. And in fact, that was as predictive as differences in IQ. Right? And many of you know probably that now there's a lot of effort by people in the education space, in child development, picking up some of these things and actually trying to teach children self-control, right? Many of you have heard probably grit, right? The whole debate around grit, and the idea that these type of behavioral issues might not even be innate. They might be teachable, right? But we need people to teach them. I just wanted to show this to you here to basically say how important these type of factors can be in improving people's decision-making. But as with these children, right? Our lives are often very busy, and we might not always have even the mental space to think about these things when we make financial decisions. And so, therefore, if these type of aspects of human behavior are important, we need to understand how the financial industry interacts with people that have these innate flaws. Right? And so this is what I want to talk to you about today. Basically, why are all these fun examples, if you want, why are they important for finance? Especially today, I want to talk about why they are important for retail finance. And what I want to argue is that banks and financial institutions, and of course, consumer finance industry more broadly, the consumer industry more broadly, is very much understanding the importance of behavioral issues and incorporating them in the targeting of customers, in the way they market to people, and even in how they shape the contracts that are being offered to people. And so that's what I want to show you today. Basically, I want to show you how, in one example that I've done a lot of work on, which is the credit card industry, how firms are actually using the knowledge of behavioral finance in targeting different types of customers in a different way. And I also want to show you how difficult it is for consumer finance regulation to undo some of these things, right? So it's not enough to say, we just need to regulate this whole thing better. Because this is a very dynamic game between the supply and demand side. And in the end, I guess what we really need is to make people more sophisticated about how they use financial tools. All right, so even more broadly, why this is so important in my heart is that in the US, where we have a ton of different choices and where people are typically able to get a lot of information about different financial tools that they have or different financial products that they have, you can say that this issue might not be as big as in many emerging markets where people have much fewer choices and where people, if you think about it, have also much less the ability to protect themselves against their own worst instincts. So for example, right, a simple example. If I didn't have the chance to set most of my personal finance up in an automated way so that I have automatic overdraft, right, everything is being deducted immediately, I would be late on everything all the time. I mean, let's be honest, right? But we have a beautiful setup in the US where you can do all these things. Now think about somebody in Uganda or in India, right, where you don't even have a banking system that allows you to set things up in a way to help yourself undo these, problems you might have with procrastination, with inattention, then you're really stuck in a situation where those things loom large. And I'm doing a lot of work on financial inclusion in emerging markets as well, and there we see that these things really operate on steroids even, compared to the US. All right, so having said that, let me show you some of the things that we have done. So this is from looking at credit card markets in the US. This is joint work with a former student of mine, Hong Ru. And so what we did here is we used a large-scale data set from a consulting firm called Compromedia that has been collecting information on all credit card offers that people in the US are receiving over the last, 20 years. So what do? What they do is they have a set of people on staff not on staff, but basically you can say on call, between 4,000 to 5,000 people a month who are being paid to collect all their financial mail and send it back to the company. And what do these guys do? They scan it in. So they basically get all the offer letters, even how the offer letter is structured, etc. They scan it in and they just create a database. Why does this happen? Obviously, you understand, right? This is actually how the credit card issuers are monitoring each other about any new products, any new features that are being introduced into the market. And we see actually even in that data massive imitation in this market as well, right? But so this is why this firm does it, and this is how this data is typically used. But of course, what we can do as researchers, we don't want to use it in a case-by-case basis. What we did is we built algorithms with optical character recognition software and then Python to pick out all the visual dimensions of the offer letter plus all the hard features, meaning, kind of in each offer letter that's being sent to a given customer, I can see what was the APR, what was the late fee, what were the over-limit fees, right? All the fees, but I can also see how was the offer itself structured. What was basically the visual strategy that was being used? So just to give you an example, this is an offer letter we made up because we didn't want to implicate any bank right now, but this is a very typical offer letter you see in a credit card offer, right? And what you see, first of all, right, there's a very enticing, nice photo, kind of to entice you to spend on something nice. But the other very important thing that we can basically with our algorithms pick up is, for example, which features of the card are highlighted on the front page. And what you typically see is things like the 0% introductory APR. Or if the APR itself is very low, it will be on the front page. But none of the things that are not so enticing will be on the front page, right? So things like how high the late fees are typically not on the front page. Whether there are over-limit fees or not on the front page. I'll show you some statistic on this in a second, right? And the other thing we can see, we can even figure out, how big is the font of certain things, so certain features, relative to others. So, right, you see here, 0 introductory APR, quite big. The fact that the APR will reset to almost 19% after 12 months, right? These guys are, to be honest, this is even generous because typically they don't even put it on the front page, right? It's only on the last page. Why is it on the last page? Actually, because there's regulation in the US, right, that forces issuers to document and disclose all the information in what is called the Schumer box after Senator Schumer. And what you see is basically that the negative information about the card are always hidden in the back. In fact, this is pretty genius if you think about it, but the companies even go to the extent that the front page, is always on this beautiful page, very glossy. The Schumer box page is typically on super rough paper where you worry that when you touch it, right, the ink will stick in your finger. So, kind of it's even, at the level of tactile psychology, they're very good at trying to make you not look at the unpleasant features of a card. So, however, because we have the Schumer box, what we have for our research then is we can see all the, I call them hard features of the card, right? I can see what is the APR, what is the, say, what are the late fees, penalty payments, annual fees, reward programs, etc., right? And then what we can see, as I said, is how the firms actually are using them. So let me tell you what we then find. The first thing we find is that there is, maybe not surprisingly at all to you, there is a lot of shrouding, we like to call this in finance, shrouding of the unpleasant features or the unattractive features of the card. In particular, we find that card features that happen late, if you want, in the payment cycle, like over-limit fees, late fees, penalty APR, they're all hidden in the back. And attractive things happen in the front. So, kind of given that this is MIT, I thought I'd show you at least some statistics. And look what you find, right? Not surprisingly, as I was saying, this is kind of the features that a card might have, and here is whether it is displayed on the first page or not. And as I was showing you, look, things like late fee, default APR, over-limit fee, right? Basically never displayed on the first page. But of course, things like whether the card has an intro APR, whether they have miles or other rewards is always on the first page. One thing I want to highlight for you, and I will come back to this, is actually this bit here. So you see, it's kind of interesting that the annual fees are displayed on the first page, right? And typically you can say this is, so it's not even just required, but actually what happens is that it's a trigger, right? You said it's a trigger, exactly. So what we find is that annual fees are tough to hide, because even if I hide them from you, as soon as you start the credit card, you need to pay them. So there's no way for me to hide it. But what we did find is that annual fees are typically only targeted at more educated and richer people. And so this already, and I will come back to this, shows you, and that is something we find over and over in our studies here, is that sophisticated customers cannot be fooled, if you want, or cannot be targeted with these type of shrouded features, as well as unsophisticated customers. And so once the credit card company understands it, it will actually not use these shrouding techniques to sophisticated customers. Why? Because a sophisticated customer understands that a zero APR without any cost is impossible, right? The bank has a cost of capital. I can't give you a zero APR. So a smart customer will go and search for, well, where's the trick, right? Where are you charging me? And if you're hiding how you're charging me, I get upset with you. So as the offerer or the issuer, I don't want to shroud or, if you want, mislead the more sophisticated customers, because I know they already know what to look for. So these type of techniques are particularly used for the less sophisticated part of the consumer space. I should say though, right, and Archana and I were discussing this before, sophisticated doesn't necessarily just mean smart or dumb, right? As we were saying before with these behavioral issues, you can be very smart, but if you are distracted or super busy, or you're just the type who is not massively organized, right? These type of techniques might work on you as well. In fact, it's even better, because the rich and stupid are the best targets, right? Because they don't default on the bank. And so this is where you really want to do the rent extraction, right? So one final thing I want to show you is, you really see that the banks are quite deliberate, or the issuers are quite deliberate, because this is saying, if an item, say like late fees, does occur on the first page, which is, as I showed you, very rare, then it is because they are at a much lower rate than typical, right? So I'm highlighting features where I'm trying to be very competitive on. All right, all this, maybe not so surprising. You've all stared at credit card offers probably yourself, so you might not be so surprised about it. The part that I found very interesting is that we see this, so that these techniques really are targeted at sophisticated versus unsophisticated people in a different way, right? And so here are some results in what we found. So what this is telling you, so these are results from a regression analysis, or think about it like a machine learning analysis, where we're controlling for all the other features of a household. So, the zip code you live in, your family status, your income, your FICO, whether you're a house owner or not. And all I'm showing you here is how do people of different education level load in terms, say, of the APR, default APR, late fees, and so on, relative to, so these are the less educated people versus the highly educated people, right? So people only high school all the way here till people, kind of who have masters and more. And what you see, right, interestingly, is that on things like APR, we don't see much sorting on the education dimension, right? Meaning, the sophistication dimension. But where we see massive sorting are on things like late fees. So when I look at late fees, what is this saying? This is saying that people who are very educated have an almost 50% lower likelihood of being offered a credit card with high late fees, compared to someone who just has college, just has high school, right? And you see that this actually quite, kind of monotonically goes down here with your level of education. Same is true, I can show you the same thing for over limit fees, kind of and other, kind of penalty fees. And so how do we interpret this? This is suggesting that people that are more educated are targeted less with those backloaded and shrouded fees because, as I was saying, right, as a pool, we know that they are paying more attention. While people who are not as educated, right, as a pool are not paying so much attention to these issues and therefore are targeted with it more. Remember, this is just statistical. So right now, this is literally the offer letter that occurs in the mail. What this also tells you, right, is that actually, I know I don't want to sound like a sob story, right, but this is basically saying people like me who are inattentive but highly educated, I benefit from the fact that the rest of my peers are attentive and smart, because the average mailer that comes into my mailbox is already of higher quality than the average mailer that comes, say, into the mailbox of a single mother working, at minimum wage, right? So this is basically saying that just through pure statistical targeting, my life is already made easy, even if I just randomly pick a mail out of my mailbox, compared to somebody who is in a different pool, yeah? Now, of course, we're also doing some work if now the firms on top of it will have information about how I actually pay my credit card once I'm a customer of theirs, right? Then the targeting will become even more precise about my specific behavior versus the behavior of the rest of my pool, etc., right? But this is exactly right what I wanted to show you in terms of the targeting of sophistication. And you see, interestingly, I just put this here as a comparison. If we look at the sorting by income, it looks very different from the sorting by education. And this is what I was saying before. Look at this, right? So after controlling for everything else, you do see that richer people indeed have higher APR and higher late fees. But this is, this is what I was saying before. This is because once you identify the inattentive rich, it's great for you as a financial institution, because those people have the means to pay you and therefore don't become a credit risk, even when they don't fully understand what type of credit card they might have subscribed to. Yeah? All right. So let me, kind of, as I was saying, right, this MIT, I just have to show you some statistics. But the only thing I want to show you here, this is actually, these are the graphs that I showed you before. The one thing I want to show you quickly is that even if I look at how the credit card offers are designed, we find again, so this is saying, are the late fees only shown in the back? Or is the default APR only shown in the back? And what you find, right, if I sort people here, I mean, think of it like a sorting, but as I said, with all the controls behind them, what you find, right, education 2 here are the people with just high school, and then you see this is people with college and more. What, again, you find is that more educated people, even when I offer them high late fee, are more likely to have this late fees shown on the front page than less educated people. Than more educated people. So let me say this correctly this way around, which is the less educated you are, the more likely you are that the late fees are just hidden in the back, or that the default APR is just hidden in the back. Right? And it's exactly this idea that for a sophisticated customer, they know what to look for, and so I don't want to hide things from them that they anyway are going to look for. Yeah? Okay, perfect. So the final thing I want to show you in this context to in a way highlight how the dynamic of this type of behavior interacts even with regulation is, I call this regulation by whack-a-mole, right? But what we have seen, and I'm sure you remember, right, is after the financial crisis, the Consumer Financial Protection Bureau tried to implement a bunch of changes in the consumer financial market, especially with the Card Act of 2009. And in fact, the Card Act of 2009, one feature of it was exactly addressed towards these type of fee structures that I just showed you. So what the Card Act did, right, it changed a few things in the credit card market. So one general thing, and that has proven quite important, is that it forces underwriters to give people enough time to know about their bill so that they can pay back, right? So what this basically said is that you have to send the monthly statement to a customer at least 21 days in advance. That seems like a no-brainer that you give people at least some time, but there used to be some participants in the industry who did a relatively poor job in sending people things really late so that the customer then paid late, right? That's all fine. The other thing that the Card Act did is that it didn't allow retroactive rate increases, meaning you have signed up with a credit card and then you get, maybe half a year later, a letter in the mailbox saying, oh, you thought you had signed up for a card at 12%, now it's 18%, without any reasons. That used to happen quite a lot. But the part, that actually seems to have affected the industry the most, and then there's, less marketing to young people. But the thing that seems to have affected the industry the most is actually the fact that now, in two phases, what they implemented is the reduction of what is called fee harvester cards, meaning the Card Act did away with over-limit fees, right? You cannot charge over-limit fees now. And the second thing that it did is that in the initial offer, the late fees are restricted to $25. Yeah? Before, the average late fee on a credit card was actually $39. And it was $39 even if you were just $1 late, right? So that was obviously very, very punitive. And so what we then looked at in our research is what happened when these changes affected the industry. And you can already probably think where I'm going, is that, of course, the cards themselves changed, but it changed in a way to try and bring back some of these features of shrouding that now, through the regulation, were trying to be taken out. Yeah? So if just, to be even more tedious about it, right? What I showed you before is that things like late fees, over-limit fees, all these type of penalty terms were the ones where the more fragile and less sophisticated people were suffering from, right? And so these things were now explicitly targeted in the Card Act. One thing, though, that the Card Act did is it gave the industry, if you want, one loophole. And what is this loophole? So what it actually said, what is still allowed, right, even under the Card Act, is to say that fees can be reset either at the end of an introductory APR period, right? So if I offer you, say, a 12 months zero APR, and after that, I can actually say set up late fees, kind of, and penalty APRs if I want to. But the other big loophole is that, or the way this was formulated is, so you can reset them at the end of the intro APR period, or earlier if the household once pays late. So if a household, say, during the introductory APR period, pays late once, all these protections actually go away, and you can now set up late fees, penalty APR if you want to. And you see, if you believe kind of what I was telling you before about the behavioral proclivities of less sophisticated customers, what you want to do as a card issuer, right, is you want to, in a way, bring back some of the backloading in a different way. And so let me show you how this actually happens. So the first thing I want to show you is, yes, the industry actually did comply with did comply with the reforms, right? So what you see here is that we see kind of an almost, kind of 5% decline in late fees, which is exactly, what was supposed to happen. And the other thing, you see a massive decline in over-limit fees. The reason is just that you're not allowed to charge them anymore, right? So that worked really well, and obviously industry is complying with this. But now, the more interesting part that I want to show you is how do the other features of the credit cards readjust? And look what you find, right? What we find is that the APR on average becomes much higher. The use of introductory APR, this is not the rate, this is kind of an almost doubling of the use of the intro APR, right, goes up, but look what happens at the same time. The period of the introductory APR shrinks dramatically. Right? Remember what I told you, it's because at the end of that intro APR, I can actually now set up things or set up fee structures back to much higher rate. And what is really interesting in the context of shrouding, if you want, is that now we see much higher feature or much more attention paid to the size of the introductory APR, right? So you see it much more highlighted in the front, while you see the APR, right, the rate at which you actually will be charged in the future, much more pushed to the back, right? Which was before not the case, right? Because before, the APR was not something that the industry was trying to shroud, right? So this is basically saying that it shows you that even very well-intentioned regulation that is trying to undo some of the, kind of the more punitive features of credit card contracts, even when we introduce it, right, there's obviously always a market adjustment and a market dynamic that can undo regulation to some extent, right? And so understanding how these behavioral issues of customers interact with the incentives of the issuers in the market will become more and more important when we go forward, right? So to sum up, what I wanted to highlight for you is that yes, FinTech provides enormous opportunities, and obviously we've seen, at Sloan every day how our students are embracing FinTech, how many really exciting new projects are being done. By the way, if you are ever interested, we have now a class on FinTech Ventures that brings together students from course 6, so from computer science and engineering with Sloan students to start new businesses, and we've seen a lot of exciting new business being started, right? So there's definitely a lot of interesting and positive things going on. But what we also see more and more is that we are facing a lot of new challenges in especially the retail finance space, because a large fraction of consumers are not prepared to participate in this new digital world, and they might be very, if you want, negatively affected by the ability of credit card companies and other financial players to understand their types in much more detail and therefore target their types in a lot more dramatic ways. All right, I want to stop here because I thought I give you guys a chance to ask questions and interact.
So this is my business, and I think about this all the time. And one of the things that I've wondered that I haven't had the opportunity to really look at is when you talk about you don't think that regulation necessarily can be particularly beneficial in this country, and things are worse in developing markets. There are other parts of the world where you don't have these problems. In the US, it's 40% of all households have credit card debt. You probably know that. And a lot of the 60% who don't have any credit card debt don't have any credit cards. So it's an incredibly large and widespread problem. In Germany and in the Netherlands, I know the high-level figures, that's much less. And in Germany, where I believe you are from,
Obviously.
right? Well, I think the introducer said that. Somebody I know told me that the default on the top of a credit card statement is you pay it in full, which may not be obvious to a lot of people why that would make a difference, but it makes an enormous difference in people's behavior. So my question is, when you make the statement that you don't think that regulation can necessarily help all that much, have you looked at some of these other countries where I suspect that regulation is doing a better job of protecting people?
This is a great question. And actually, I should be very careful. I didn't mean to say regulation cannot help. What I meant to say is, regulation, even when it's well-intended, right, can have unforeseen side effects. And on top of it, right, obviously, there's always the opportunity of the industry to adjust much more smartly than often consumers who are not so well-informed. But let me say so you're totally right that in the US, there are a lot of, especially poorer households, are holding a lot of the credit card debt. In fact, if you look at, I'm doing some work with the Consumer Financial Protection Bureau right now. Actually, more than 50% of credit card debt is held by people with less than $40,000 of annual income. And people with, kind of high income use credit cards mainly as transaction cards, right? Not as credit cards with a balance. Now, you're right. So actually, one fun fact relates to what you said. When the Card Act came in, one other thing the Card Act did, it actually highlights on the top what is the minimum payment you have to pay, because they wanted to regulate that people at least make a minimum monthly payment. But in the US, this is, I think, your point, right? The minimum monthly payment is set very low, way too low. So in fact, this is not my research, but some other research shows that some people who used to pay in full, now that they get the statement that says, oh, your minimum monthly payment can be this, they started paying much less because they hadn't probably realized you can also pay not everything. So this is not good, right? So you're right that in Germany, where I'm obviously from, this is kind of regulated quite differently. I want to say, though, kind of not having so much debt is definitely a good thing in Europe. But of course, we have to be very careful in how we think about it, because in a country like Germany, because people don't have as much access to debt on many dimensions, you also have a situation where only something like 45% of Germans are homeowners, right? The same quite draconian regulation that you have on credit cards, which we might like for good reasons, applies, say, in the housing market as well in Germany, and it makes it very difficult for poorer people to buy a home. And so you see, kind of that then you also get big impact on wealth distribution things, right? When you are not allowing people who might not have as much savings to participate in the market, right? I mean, I'm saying this because while you are right, that not everything is good here, not everything is good in Europe either, and we want to be very careful about it. This is another pet peeve of mine, though. If you look at what happened, unfortunately, I feel, over the last decade after the financial crisis, is that because we made the mortgage market, people say, right, we made it much safer. That's true, we made it much safer. But how? We made it safer by cutting the access of lower income and lower FICO people to mortgages. And so what has happened, actually, if you look, is that over the last 10 years, the participation of poorer households in the housing market in the US has gone down quite significantly. And actually, mortgage debt and housing has shifted much more to older and richer people. And if you think about it, this is a horrible story, because it means we have used a ton of taxpayer money by subsidizing the hilt out of Fannie and Freddie to support the rich and the old in the US. That cannot be good policy, right? I mean, that is extremely regressive. That really doesn't make sense. So, so these are, and why? And how? Exactly, again, by making it tougher for poorer people to buy into the housing market when the housing market was actually, if you want, undervalued, right? Now, mortgage access has become much more, in a way, generous again, but now prices are high, right? So these are the kind of things where I feel regulation really needs to step up to address the social issues in society. All right, this was a long answer. Let me take a next question. Yes.
Hi, great talk. Could you please comment on the differences in your numbers between the offerings and what really people are, taking on a credit card? Thank you.
It's a really important question you're raising, and I didn't spend so much time here. So you're right; these are all offers, right? This is not yet what people are taking up. So what, indeed, I was saying, right? We are working right now with the CFPB to match take-up data to offer data. Right? And I will have much more precise answers for you in hopefully a half a year. But I can already tell you when people just look at the way customers use their credit cards, you do find that especially less educated and poorer households pay much more in fees, especially late fees, over-limit fees, penalty fees. So if your concern was, maybe these credit card companies send you all these crazy offers, but people are smart enough not to take them, unfortunately, the answer is no, right? People are indeed, taking them, and they are somewhat, if you want, misled by them, or at least enticed by them. In fact, if you talk to any credit card offerer, they will even tell you that the way people shop for credit cards is when they have a credit need, they look into their mailbox and they look at the 4 things that are in there and choose maybe between them, right? But they don't say, I need a credit card over the next 3 months. I'm really going to figure out how this market looks like and pick the best for myself, right? Yep.
Hi.
Go ahead.
Thank you. Switching a little bit into financial inclusion, and you mentioned big data. Mm-hmm. We've been using a lot of data in the past of bad debt for scoring and things like that. Now, how do you think, or what are the things that you've seen are working in terms of using more sophisticated mobile phone data, telecom information, or services information on consumers? And how does that play against everybody afraid of sharing information into the Googles, the Facebook, and how is that going to play out, or what are the things that can be done to really use that information in a reasonable way for consumers that feel comfortable in sharing that for better financial inclusion?
Yeah. So this is a very big question and a very big debate, right? So maybe let me say 2 things to this. One is we already are seeing the use of lots of social media data by social media companies, but also by banks, financial companies. And there are a lot of aggregators who are already using, right, your shopping behavior to predict what you are liking, what you're not liking. And a lot of it is good stuff, right? If you remember, even say 2 years ago, maybe, think about simple things, like you might be looking for, I don't know, a credenza on Google, right? And then you bought one, and for the next 6 months, Google would give you more credenzas to look at. And you're like, this is useless, right? Nowadays, actually, I just bought a credenza, and they're offering me cutlery and, so in some sense, that's good, right? They're targeting me with things that I actually want to buy and with products that I need, right? Rather than information that's useless. In fact, if you even introspect in yourself, but I see this with lots of the financial service companies I work with, we have all become so spoiled that if you target me with something wrong, I have no patience for it, right? People feel like you're wasting my time. You should have understood that now I'm looking for an auto loan, so give me the things of the auto loan, right, that I need. So you see, in some sense, you can say, philosophically, I don't want to say whether it's good to be impatient. Maybe we should all be much more patient, and that's in the world as a whole a bad trend. But for the efficient use of my time, those things, right, have made a big difference. Now, what we've seen, for example, is, a lot of large banks and large companies have completely moved away of using simple models like Equifax, and are using their own very bespoke models with much more sophisticated data. Why is this good? Actually, you can see, kind of over the last 10 years, the default rates and the loss given default that issuers had to endure on, say, credit cards, on other unsecured consumer loan is as low as we've not seen in 60 years. I mean, and then we don't have data before that, right? So we've never seen for such a long time period such low default rates. And a lot of it has to do with the fact that the industry is doing a much better job. And why is this so good? It's so good because it means it reduces all our cost of capital, right? The more we can screen out people who will default on their loans, the less we all need to pay, right, a premium to make the issuers break even, right? So these are all very good things, I feel. Now, there's always a but, right? And you were hinting at this, right, which is, right now, it seems, especially in the US, but that's true worldwide, people are extremely willing to share their data actually for free, right? I mean, you were phrasing it, how can we make it so that people share their data? But actually, people are sharing their data without even thinking about it, right? Most people click through any consent thing without even thinking. And actually, I've seen some recent data. So many of you know, right, that in Europe, they recently had this GDPR where companies actually have to do much more detailed, of course, accounting of all their data, but also disclosure to their customers. What happened there? Same thing, right? Even though you now have to give your customer an option to customize how you want to share your data, typically people click through, right? Because it's even too much bother to figure out, kind of the different option of how to share your data. So I feel, unfortunately, right? These things that I was showing you, inattention, procrastination, the fact that nobody wants to deal with these annoying little things lead to the fact that we are right now divulging our information for free. What I think the future has to be is that we flip the property rights of data. What I mean with this, right? If you think about right now, by law, the Googles, the Amazons, the Facebooks of this world own your data when you log onto their site. But that is not clear that this needs to be this way, right? And technology could help us to flip this, meaning that we all could have cookies on our computer that collect our search history, and whenever a Google, an Amazon, and a Facebook wants to build an algorithm to target me with the next credenza, right? So they have to pay for my data to be included in their algorithm. And the same thing, however, is then true, say, for a startup that wants to compete in that space. And actually, in my opinion, that would have two really big benefits. First of all, your data and my data would be myself. We would get tiny amounts of money for this, but that's fine. But more importantly, actually, it would also level the playing field in the competitive behavior of different offerers in the industry. Because I'm sure what you guys have also seen, right? There's a huge debate right now, especially in the tech industry, about whether those firms are natural monopolies or not, right? And whether the fact that they have the scale economies of big data will make it so that in the future, startups will find it tougher and tougher to actually compete in this space, right? And so, in my opinion, right, there's a huge amount of need for technology to change this. And actually, I've seen a number of startups that are working on this right now, right? And applications like blockchain, but also other applications might actually be very helpful in automating this. Great, go ahead.
I've been told this is the last question. Sorry, guys.
Yes, thank you very much for your talk. I want to go back to the first question because I want to push back a little bit on your answer. Because you mentioned the German market. I'm from the Netherlands. I am in the mortgages. Mm-hmm. And the Netherlands has one of the highest mortgage rates in the world. Right. What I miss a little bit is the context of culture. Mm-hmm. Because the reason why the mortgage participation in Germany is lower is because it's a culture of renting and culture of buying your house with a very big, first. And in the US, it's very culturally acceptable to have that. And in Europe, it's not culturally acceptable to have. So it's
But in
not only
Netherlands it is.
Sorry?
In the Netherlands, it is
Yeah, but
culturally
for a mortgage, and it has the lowest default rate, so it's a very specific. It's but having credit card debt in the Netherlands is, it's not acceptable culturally. It's something you're not going to pay 18%. Come on, give me a break. So I think it's not only a matter of what you offer, but also what the country and the culture tells you what's right or wrong.
So, let me say yes, right? I completely agree with you that every financial market is embedded in a social consensus and, maybe what you call a culture, right? I'm completely, on your side with this, but I do also believe that those type of cultures obviously can change over time, and what you might think is a culture, right, is very much created also by the regulation that surrounds it, right? And unfortunately, I do believe that, and we don't have to discuss Germany right now, but Germany is an economy that is very much dominated by the large banks, and large, very, if you want, conservative banks that are not actually very great at managing risk, right? Just look at Deutsche Bank. So they want everybody to be, sorry, but I think this is not inside information. So, they want to make consumers very conservative, and they don't want to have to deal with that risk, right? But actually, consumers are hurt by this, because actually, even right now, where you see in Germany, house prices are starting to go up. You had Germany was at the zero lower bound interest rate for such a long time, and still it took almost 10 years for slowly participation rates in the housing market to go up, right? While wealthier people were actually buying more and more houses, renting them out, etc., right? So sometimes a culture, you're right, might be there, but it might not always be a good culture. And so around mortgages, I feel it's actually a problem in a place like Germany, right? Because if you look at wealth inequality in most of continental Europe, and especially, say, in Germany, it's huge. While income inequality looks smaller than it does in the US, because of participation in real estate markets, you have massive wealth inequality. And that, I feel maybe it's a culture, but then it's a bad culture, no? Then we should figure out how to improve it. I mean, that's kind of why we're here, no? So anyway, I think I'm at the end of my time. Thank you so much for your attention and participation, and I hope you have a wonderful weekend. You brought us great weather, so thank you very much.